So in the last part of this chapter, we're going to look at the other benefits and costs of stock markets. Well, most of the time, economists are thinking about stock markets as the way capital or savings is channeled in the economy. One of the ways, along with banking and the bond market. So, if we think about it, new stock issues, when a company issues stock or sells stock initially, it is earning money from that. So let's say a company, when Facebook, for example, had an initial public offering and it sold millions of shares of stock, it earned a tremendous amount of money when people bought that stock from Facebook. They were selling shares of the company. The stock is signifying partial ownership in the company. That capital that was earned by Facebook through their initial public offering was money that they could use either to distribute to the entrepreneurs who started the company or as a way to effectively finance for new acquisitions or investments in equipment, plant, or human capital for the company. So the stock market is as a means of raising funds and helping finance investment is a key way that we view it. Another way that it's viewed is a way to reward entrepreneurs. The idea of a successful initial public offering is something that's very tantalizing to a lot of people who want to start their companies, because they know that through that they will become fabulously wealthy. Another function of stock markets is that on a daily basis, stock prices basically provide information on how well a company is being run. Now, you don't want to, if a stock fell on a particular day, what you really want to look at is how much it fell relative to the market and relative to stock prices of companies in the same industry. These are so-called event studies that analysts do to see how is a stock performing of a particular company relative to its peers. And that's important in seeing, well, how well is this company actually being run? Based upon the hypothesis, the efficient markets hypothesis, that news about the finances and activities of a particular company will be quickly transmitted to the stock price, and then people who don't have to study or analyze the actions of the company can just look at the stock price for information about how well the company is being run. This is very commonly done if you read any of the financial press. Stock markets also provide a way of transferring company control from less competent to more competent people. As it gives you poorly run companies with low stock prices can be bought out by people who think they can do better. You have a lot of firms which are really private equity firms that buy up companies with low valuations, reform them, and try to make money when they resell the company after they've reformed it. A downside of stock markets is that they are susceptible to speculative bubbles. Bubbles occur when asset prices, including prices of real estate or stocks, rise far higher and more rapidly than could be accounted for by the so-called fundamental prospects of a company or an industry. They're based upon human psychology of the herd mentality, which stock markets can be susceptible to, just like other kinds of markets. The difficult thing is that speculative bubbles are very easy to spot ex post, but not necessarily so easy ex ante. Some people are going to spot it, but the whole idea of the bubble is that it's not that the bubble exists because most people are not convinced it is a bubble. If it did, if they were convinced, they would sell and the price wouldn't rise as rapidly and the bubble wouldn't exist. So almost by definition, a bubble can only happen because it's difficult to spot. This is a graph of the bubble that existed in tech stocks in the late 1990s. And when it burst, it helped lead to a small recession. What the connection between the bursting of a tech bubble or a stock market bubble and the recession is given basically by looking at the connection between a person's wealth and their spending. What happens when a bubble bursts is that people's paper wealth has declined, so they're less likely to spend. They may have been having some of their retirement account in that particular amount of wealth, that stock market portfolio. If the value of the portfolio falls, they feel poorer and they spend less and save more to try to build back that wealth. It's exactly what has happened post 2008 when that stock market fell by half, and post 2000 when the dot-com bubble burst. In addition to this fall in spending and therefore a fall in GDP, which happens when a bubble bursts, there are these negative effects because speculative bubbles means that capital is not really being allocated efficiently. It's being allocated to places where people think it's valuable, but they're incorrect. It's just really a bubble mentality. So, in sum, the economic costs of bubbles are that one, when the bubble bursts, it can lead to economic downturn or a recession. That will have as a consequence labor dislocation and unemployment. And two, during the run-up of the bubble, it leads to a misallocation of capital being invested in areas where it is not really reflecting the long-term value of capital. It's just merely a herd mentality. And that means that in other areas where it would have had higher rates of return, they're not seeing that capital.